Okay, hi everyone. Thank you very much for joining us today. The main purpose, I'm just going to quickly admit someone else there. The main purpose of today is really just to go through the change of basis periods for those people who don't know much about it or those who do know a bit about it but are simply wanting a bit more detail on what this means for them. So we've decided to do this because we've been speaking to practices, and what we've found is that not everyone knows that much about it. So in 5 minutes or so, Stacey is going to go through what this does mean with you all here today. And also, we'll have some of our clients on the call as well, which is great to see, who are here just to get a bit more detail on this as well. So in terms of the agenda for today, I'd like to take the opportunity just to introduce our healthcare team here at Robson Laidler, because there has been some changes in recent years, and we're also going to go through some other topical matters in addition to the change in basis period, some administrative points for consideration too. So hopefully everyone will get something useful from today. We'll promise to keep to the time frame as we know how busy everyone is in the day job. If there's anything we don't have time to cover off, we can email that across to you separately. We'll also be recording the webinar here today, and we'll get that sent over as well. Okay, so firstly, for those of you that don't know who Robson Laidler is and who our healthcare team are, I thought I'll just take a couple of minutes just to tell you a little bit more about us. So we were founded in the 1920s, over 100 years ago now, and will remain independent after all those years and continually strive to remain so. So 8 of our current directors currently co-own the company. We have 2 offices, one in Jesmond, here in Jesmond, where our healthcare team is based, and we'll also have an office in Chesterley Street as well, which is great. Our team has got flexibility to go to and from the offices, and because our healthcare clients span both sides of the water, it's quite useful in terms of getting to and from practices. We'll have over 100 people working at Robson Laidler across the group, and 7 of those are within the healthcare team full time. 2 key brands, our accountancy and business advisory offering, and also our wealth offering as well. So we'll provide lots of services across the various departments. And as I mentioned, we've got 7 of our staff that work specifically within our dedicated healthcare department here at Robson Laidler. But in addition to those 7 people, we'll also have tax clerks from within our tax compliance team, who have that experience working with GP partners, dental partners. And we'll also have some dedicated tax advisors who support our healthcare clients, and we'll have a financial planning team as well, who are experts in the NHS pension scheme, part of ASNA and the UK healthcare group as well. And then I've got a couple of other extra things on the slide there. We were the first accredited business within the North East to achieve the B Corp accreditation, which is something we're very proud of. We're leading the way in using our business as a force for good. And we were recently placed in the Sunday Times Best Places to Work listing, which is excellent. We're one of 4 accountancy firms across the UK to make the listing. Over 70,000 businesses applied and only 1% in total were listed. And I'm sharing this with you all just because I believe happy people make for a more motivated, dedicated workforce, which ultimately leads to excellent client service. And our healthcare team is just that excellent. We've got pictures of people on the screen there that you can see, so you can put a face to a name. So we'll have Stacey, first of all, who heads up the healthcare department. She'll be taking over in a moment or two just to talk about what we're here today to talk about. Stacey's a qualified accountant with over 20 years experience, and 20 years working here at Robson Laidler as well. We've got Liam, who holds client relationships with both our GP and dental clients, and he's been working within the healthcare sector for over 10 years as well. We've got Emily, who also holds client relationships and a portfolio of GP clients. So Emily works specifically with our GP clients. And again, she's been working within healthcare for a number of years, as is Zach as well. Zach specifically works with our dental clients. We have a lady called Sarah who joins us next month. We just want to make sure we've got that extra capacity within the team, and Sarah will be joining us. at the beginning of July, and we have Lawrence and Annika as well, who are our two newer members of staff. Lawrence has been here for a couple of years, and Annika joined earlier this year. And he's not on the screen there, but our longest standing member is Kevin, who some of you know, who's recently retired, but will come back and forward depending on when we need the extra capacity. And he brings over 40 years experience, and you've got myself as well with over 20 years experience. So that's a bit about us. I just wanted to use that opportunity to tell you a bit more, but over to Stacey to go through the changes to the basis periods, which, as I say, is ultimately the main reason you're here today.
Hi everyone. So HMRC have a plan to make tax digital. The dates have changed over the last few years. However, it is expected that this will come into place from April 2026 for unincorporated businesses. So that's going to be sole traders, partnerships and LLPs, and also landlords with profits over £50,000. The first stage was digitalising VAT, and that came into force from April 2022. The next stage is to bring the tax submissions in line with the tax year, and this is where the basis period change comes in. So from 2024-2025, all unincorporated businesses will be taxed on the profits they earn in each tax year, regardless of the accounting year end of their business. So that means for individuals who have not been recording their income in the tax year it was earned, they have a catch-up to make in 2023-24 year, which is considered the transitional period, ready for the change that HMRC have dictated to be in place for 24-25. So what is the current process? So profits are currently taxed based on the accounting period date they are included in. So for accounting period ends the 31st of March and 5th of April, these profits would fall nicely into a tax year that they were earned in. But for non-coterminous accounting periods, the profits earned would fall across 2 tax years. However, they would only be reported on a tax return that's in the later tax year. So for example, profits included on 31st of March 23 accounts period would be taxed in 22-23. But profits in the 30th of April 23 accounting period wouldn't be taxed until 23-24. When you first set up a business, having a non-coterminous year end was considered good for cash flow because you effectively got some extra time to pay a tax bill. And if there'd been no change to the basis period, you would carry on submitting your profits on this basis until you retired or ceased to be part of that business. And you would have a catch-up position, which ensures that all the profits would be taxed accordingly and any overlap profits are deducted. Your overlap profits are created due to the way the tax system operates. So depending on when you began trading, you might have paid tax twice on some of those profits in the first 2 accounting periods. This has been happening for many, many years. It's part of the way the tax system's operated, and you would be recouped when the business came to an end, as I said. So what is the next steps? So from the 23-24 tax year, all untaxed profits need to be calculated and reported to HMRC. So that will be profits for your normal accounting period end, plus any profits to the 5th of April 2024. So for a 30th of April year end, that's an additional 11 months of profit being accelerated for tax purposes. So HMRC have confirmed that the overlap profits that you may have had from the beginning of your trade can be deducted from the transitional profits, and they are enabling some tax planning to be able to be complete on these profits, where you can spread any remaining transitional profits between the 11 months period of profit, less your overlap profit, can be split up to a period of 5 years, with a minimum of 20% being reported in the 23-24 tax year. So this means for individuals where profits are higher than they were when they first began trading, it's likely that overlap profits would not cover the transitional profits in full, and higher tax bills will be expected come January 2025. So I've pulled a couple of examples together so you can see what this looks like with actual figures. So this example is based on a partner within a partnership's taxable position. So where the business has a 30th of April 2023 accounting period end, with taxable profits of £96,000 in that year. They amended their accounting period to the 31st of March 2024 and have calculated the transitional profits of 88,000. They have overlap profits brought forward of 40,000 to be offset against the transitional profits. Therefore, the accelerated taxable profits are 48,000. This partner has already made some payments on account in January and July 2024, totaling 30,800. So how would your tax have looked without this change in the basis period? So based on the profit in 30th of April 2023 accounting period of 30,900, less the payments on account of 30,800, you would have been left with a balance in payment of £100. You then add on your payment of account of 50% of the annual tax charge, which would be £15,450, which means if there was no changes to the basis period, your January 2025 tax payment would have been £15,550. Now you can opt to tax all of those additional profits, so a full 144,000 for the 23-month period in the 23-24 year, if you want to. So if you take that option, we need to ensure that the January 2025 payment on account is reduced in line with expected annual profits of 2024-25 and not within the profits that you're reporting for the 23-month period. And if we look at those calculations, taking off that payment on account, you would be looking at £41,600 of tax that would need to be paid back in January 2025 on those accelerated profits. That's an additional £26,050 of tax during January 25, and they would have lost all of their annual allowance in that year. As I noted earlier, HMRC are enabling you to split that transitional profit over a period of up to 5 years. So if we have a look at the next slide, we can see we've done a working on this as well. So in this case, the 48,000, that transitional profit, can be split over a 5-year period. Therefore, the minimum that needs to be applied to the 23-24 year is £9,600. So if we split that transitional profit and add it to the profits for the 12 months, 30th of April 2023, the profits that need to be taxed is £105,600. So what that does is enables the partner to retain and preserve some of that personal allowance. So £9,770 of that profits will still be at that 0%. Tax on those 105,000 of profits would be about 36,000. We take off the payment of account of 30,800, and that would be left with a balance in payment of 5,200. The payment on account for this process would be 18,000, which is half of the tax on the profits for that accounting period, because we're carrying forward some of those transitional profits into future periods that will need also to be taxed. Meaning the January 2025 tax payment would be £23,200. So that's still a £7,650 increase in tax at January 2025 that would not have been expected originally had any of these basis periods not have been changed. It is £18,400 less than if you were allocating all of those profits in the 23-2024 year. So this shows how important it is to be having a look at these numbers and reviewing the tax positions and whether there's any tax planning that needs to be done. So just quickly going over those numbers again, originally, with no change in the basis period, your tax would be £15,550. If you bring all of those profits into one tax year, 23-24, your tax position is £41,600 at January 2025. And if you split the transitional profits over a 5-year period, the taxable payment in January 25 is £23,200, and there'll still be additional taxes in future periods due to those profits that you're carrying forward. So this is one of the reasons you need to know that these changes are happening. The tax planning is going to be key to ensure that you can manage your tax liabilities and the payments that are coming up. The 23-24 transition period's the only year that HMRC are going to allow you to split those transition profits over a period of up to 5 years. So you need to have a think and look at those within your own personal circumstances to see what that looks like for you. Although the basis period change relates to individual tax positions and not business accounting periods, as part of this change, we are encouraging our clients to change their accounting period to the 31st of March 2024. So this means you do not have to change, you don't have to change that accounting period end. However, there will be some adjustments that you need to calculate the figures that need to apply in your tax return if you don't. So if you have a 30th of April year end and you choose not to change the year end, so it falls in line with the tax year, you'll need to prepare 2 sets of accounts in order to obtain final actual profit figures that will go on your tax return. The calculation for the transition year will remain largely the same. So although you will have to prorata 11/12 of the profits recorded in the accounts of 30th of April 2024, going forward, you'll need to take 1/12 of profits from the 30th of April 24 accounts and 11/12 of your profit from 30th of April 2025 accounts, and then calculate the taxable position that needs to be reported on that return. You can estimate the profit position in your accounts for your tax return if the accounts are not complete. However, you would only be able to submit a provisional return. A final return would still need to submit following actual figures being obtained, and if you've made any underpayment of tax, interest will be applied for any shortfall. This will be especially difficult if your business falls within a 31st of December year end, as you'd only have 1 month to complete final accounts prior to the tax deadline. Changing your accounting period will enable you to have better reporting and overall view of your financial performance and how these will impact on your tax positions. This will also bring in the accounting period in line with the tax year, but also will line up with NHS contract and pension reconciliation periods. Come the 31st of March 2025, there will be a full 12 months reportable accounting period, and you will not have to wait for 2 sets of accounts to be prepared in order to split those profits into the correct tax year and know what your tax payments will look like. So we know that some accountants have not had discussions with their clients regarding the changes to the tax basis period. We've just taken on a GP client with a June 23 year end, and they didn't receive their final 23 accounts until last month. It's a 3-partner practice, and none of them had any idea that they would be looking to bring 21 months of profit into the 23-24 tax return. Now, we can only speculate as to why accountants are not discussing this major tax change with their clients. It's either they're not aware, they don't understand the changes, and where this was first announced, there was some ambiguity around the guidance of how it would be implemented. However, this has long been settled. It could be also that they understand the changes, but know that there's an increased level of work involved, and they've taken the decision from you to manage their own workload. The change is coming, and profits the 1st of March 24 need to be reported to HMRC within the next 7 months. That's only 232 days. If the change to the basis period will affect you and you have not had these discussions with the accountant as yet, we would be happy to have a conversation with you on how we can help to obtain the information you need, so you don't need to be taken by surprise by a big tax bill come January. Just pop a comment in the chat box and we'll get back to you after the webinar. Thank you.
Okay. Just whilst I've kind of got everyone on the webinar, I thought it would just be, again, just a good opportunity just to run through some topical matters. So just basically some things that we've been talking to our clients about just in recent months when we've been meeting with them. And I'll just apologise in advance if there's any dentists on the call, because they are probably a bit more specific to GPs. So firstly, seniority. So in the last couple of months, we've seen a large number of practices face a deduction for historical overpayments of seniority. And likewise, some have received top-up funding as well, which is always quite welcomed. So this is after some long overdue seniority factors were finally calculated. The calculations have been done for the years 17-18 through to 19-20. And if you've received any notifications, just get in touch with your accountant to see firstly whether this was expected, and secondly that it is correct. They're a better place to advise on whether or not you should be having that deduction. We kind of have logged on the portal where we've got access to PCSE for our clients and had a look at what's on there. So with our clients, where anyone is affected, we've kind of notified them accordingly. But ultimately resolving the payments in particular can be complex, because what you'll find is a large proportion of the GPs to whom the adjustments relate will have in fact will possibly have retired, they might have left, or in some unfortunate circumstances they may even have passed away. The adjustments for 17/18 through 19/20 are expected to be taken or refunded this month. But the reason I'm bringing this up again today, because as I say, kind of people have sort of been aware of this since October, and it was the final figures were confirmed in March, April time. I'm bringing it up again today because, just in case you're not aware, the periods from 13 to 14 through to 16, 17, so 4 years are still yet to be reconciled. So there may be further clawbacks to come. And again, we'll just advise that you speak to your accountant and check what is covered off in any retirement or resignation arrangements within the partnership agreement, just so you know where you stand, particularly if you need to try and claim any of that back from a former partner. So that's one thing we just thought it was worthwhile mentioning today. And then again, I'll touch base on some new partnership tax considerations for anyone on the call that's looking at joining a partner, or for practice managers on the call who may be asked about this by say salary GPs who are considering joining the partnership. But with this, it's quite detailed, and it's always better just to sit down with that person on a one-to-one basis. It's certainly something that we're getting asked to do more and more, because if a salary GP was to become a partner within a practice, or a dental associate was to become a partner in a practice, or someone employed is to become self-employed, the tax system is going to look somewhat different to what they're used to. So you'll no longer be deducted that tax at source, and it'll effectively be collected in arrears. So you kind of, keep talking about planning, but you just need to do as much planning as you can now, so you know what you need to pay at a later date. And it might not necessarily lessen the tax burden as such, but it'll certainly make you more prepared for what is coming. So just to summarise a couple of key points, and as I say, it's always best just to do this on a one-to-one basis, but as I've said already, as an employee, you pay tax and NI at source on your earnings, on your take-home pay each month via the pay-as-you-earn system. But as a partner, you're going to pay tax and NI on the profits allocated to you, and you'll be paying that in January and July of each tax year. So you just need to ensure that you're putting enough money to one side to cover that tax bill when it comes round, because as I say, you're paying that in arrears at a later date. So half in January within the tax year and half in July after the tax year ends. And these payments are also just payments on account that in time tend to be based on the previous year's tax bill. So once they're paid, it doesn't necessarily mean that's your tax bill settled for the year. There may be further balancing payments to make if profits have increased. Alternatively, a tax refund may be due if profits have fallen from last year to this year. So again, with that fluctuation in profit, you just need to be as proactive as possible. And also, and this is something we speak to people about quite a lot, is it should be noted that the profits that are allocated to you may not be the same as what you agree to draw from the partnership and effectively take home each month. So your tax bill might not necessarily your tax bill won't be based on your take home pay from the practice. You might be leaving a bit more extra money in the practice in the first couple of years when you become a partner, just to build up that working capital. But so your tax savings need to be based on expected profits and not drawn. So again, that's just something else to flag there. And also in the first year of being self-employed, so being a partner, whether that be in a GP practice or a dental practice, it'll likely be a bit more difficult to manage because you'll be building up some of your working capital, as I've said already, and leaving a bit more in the practice, or perhaps maybe taking home a little bit less each month initially. But again, it's just about needing to know what that cash flow looks like, and what works and what doesn't work. And often that then means you'll kind of go back and speak to the practice and just negotiate something that works best for both parties. And just a couple of other extra points on that. There's no payment on account made in the first year. So when we speak about payments on account, ordinarily being paid in January and July each year, as there'll be none, you'll find that you've got quite a big first tax bill. You're effectively going to pay a full tax year's bill plus 50% on account towards your next tax year's bill in one lump sum. So again, it's just making sure you know what that looks like as soon as possible, and you can start to put that money to one side. So that's just, you know, just a couple of things to think about. And again, as we've said on a couple of things, just speak to an advisor just to understand more and just to try and get some estimates prepared as soon as possible. So then, again, just one other thing we thought would be quite useful mentioning whilst everyone's on the call. Pension deductions and I suppose some administrative tips. And again, it's something our team have been speaking to clients about, particularly more so in recent months since we submitted the Type 1, Type 2 certificates and as part of the estimates of pensionable earnings we did earlier on in the year. It's just important for pension payments to be on your radar and for you to know what you can do to make the process of pension deductions as efficient as possible. And most important, just to ensure you're not paying extra tax now unnecessarily. So just some 7 top tips there, and just be as accurate as you can be in the completion of the estimate of pensionable earnings. Just take that time to really think about what your profits are going to look like for the following year. Just ultimately, because if you can avoid large adjustments being made when the end of year certificate is reconciled, it means you're more likely to get the tax relief on those pension contributions in the year in which it relates, which is ultimately what you want. You don't have to pay more tax now because a large balance in payment is not made until the following tax year. And with regards to tax relief on pension payments, the relief is credited to you to the point in which the payment is made. So you do need to try and get those payments in the correct year. If the payment is missed, then the relief is deferred, ultimately meaning you pay more tax now. You'll pay less at a later date, but you know it places less of a cash burden on you sooner. And make sure the necessary paperwork is being submitted as soon as possible. So whatever this might be, the submission of the estimate of pensionable earnings for the existing GP partner, or the completion of joiner forms that starts a deduction of pension payments for a new partner. The sooner it's done, the sooner you can ensure the correct deductions are being taken in regards to each GP's pension. And likewise, the form for any leavers should also be completed as promptly as possible too. Then just make sure you're checking the deductions that are being made each month on the NHS statements. Firstly, to ensure the deductions correct in the first place, and secondly, just to ensure it continues to be taken as you would expect. Just make sure there's no missed deductions and no duplicated deductions, and you know that should just happen, you know, but unfortunately we've seen a lot of this over recent years where the correct amounts are just not being taken, and they've been missed, there's been duplicated payments, and leading on to my next point, it then means you're having to raise those queries with PCSE, and let's face it, I'll not gloss over the frustration it causes. So just raise the query as soon as possible, any query, just because it will potentially take a long time to resolve, unfortunately. And we haven't found a quicker way of getting that resolution. If we do, we'll share that. And then just look out for rejection notices that come through, and just pass them to the accountant sooner rather than later. Familiarise yourself with the portal and how to get a contribution statement, particularly if you're looking to retire soon. Make sure there are no gaps, and make sure any inquiries are made now, just to ensure everything is up to date, particularly if it doesn't appear to be the case. Because at the point in which you are looking to draw down your pension, to crystallise that pension, it will be delayed if everything's not up to date. And just speak to your accountant or pension advisor along the way. We're asking all of our clients just to get us access to the portal, and again we can just log on and have a look at that and support you along the way. And likewise, just familiarise yourself with how the certificate is filed via the portal. So we've processed things electronically for the first time this year, and we've found it's made things somewhat more efficient. You know, it's definitely made some things easier than what have been in the past. So we're going to continue to use that. So just familiarise yourself with the portal. And then finally, just where you can, if there are any balancing payments to be made at the end of the tax year, just ensure that these are processed before the end of the tax year, unless there's concerns that they might be taken twice in error and there's concerns around cash flow. But again, just speak to us or your accountants about that. And then finally, but this is probably one that we'll share with you separately. Stacey's prepared a life cycle, an annual life cycle, for want of a better word, of kind of what you need to do when. I don't know, do you just want to quickly run through this, Stacey? Or
yeah, so there's quite a few things that just need to be taken into account across an annual period for both dentists and GPs. So at the beginning of each year, you have to do your estimate of your pensionable pay. So that deductions are being taken from your NHS statements. NHS dentists can obtain rates reimbursements, so those letters can be prepared based on percentages of what your NHS against your private work looks like, and get those reclaims. You've got the associate pension certificates that need to be done in June to make sure that those reconciliations are complete, and any underpayments or overpayments are reconciled accordingly. Then you've got a bit of time where you're looking to prepare those annual accounts, getting in your personal expense claims, having those meetings and having discussions regarding those tax planning positions for your individually and within partnerships, and understand what those look like. And then we'll look to do pension certificates for your type 1, type 2s. And then you're looking at declarations of your mean average earnings of practice websites, and also reporting on individual earnings for GPs. So there's quite a lot to think about from March to April each year, in understanding what additional work and things need to be thought about. So this is just a reminder of what that cycle looks like and some dates of when you should be thinking about those.